Welcome to The Explainer. I'm stepping into the role of your senior analyst today, and our goal is straightforward but incredibly powerful. We are going to translate raw market momentum. Whenever you look at a chart, you're literally watching a live battlefield between buyers and sellers, and by the end of our time together, you'll know exactly how to read the language of that war zone.
But first, I've got a serious question for you. Are you just memorizing chart patterns, or are you actually reading the market? The single biggest mistake I see beginners make is treating a price chart like a flashcard quiz. They blindly memorize shapes, a block here, a line there, without ever stopping to understand the underlying tug-of-war that's actually taking place. Well, today we're breaking that habit. We're going to stop memorizing, and we're going to start analyzing.
So here's our analytical framework for today. 1. The anatomy of a candle. 2. Spotting the market pivot. 3. Riding the market trend. And 4. Reversals versus continuations. We've taken the core insights from an exhaustive 125-minute masterclass on candlestick patterns and distilled them down into a streamlined professional strategy just for you. Let's dive in.
Okay, Section 1. The anatomy of a candle.
Every single candle on your chart is telling you a story of candlestick momentum. It's the strength and conviction of buyers or sellers pushing the price in a specific direction. A large, full-bodied green or bullish candle tells us that buyers are in absolute control. A large, full-bodied red or bearish candle tells us sellers have totally taken the wheel. Understanding this baseline strength, well, it's the foundation of our entire market language.
But the plot really thickens when we look at the edges of those candles. Wicks, those thin lines extending from the top or bottom of the candle body, they represent price rejection. It's where the market tried to go, but was slapped right back down. When we see long wicks or indecision candles like the various dojis, whether that's classic, long-legged, dragonfly, gravestone, or a four-price doji, or spinning tops, we're seeing our very earliest clues of market exhaustion. It's kind of like the market's equivalent of a deer in the headlights. The dominant force is losing its grip.
Section 2. Spotting the market pivot. As a senior analyst, my job is to categorize raw data into a really clean mental map for you. For major reversal patterns, we just split them into two camps. Bullish reversals happen at the bottom of a downtrend, signaling buyers are stepping in. Bearish reversals happen at the top of an uptrend, signaling sellers are taking over. Mentally categorizing these helps you instantly identify when the market's momentum is about to completely change directions.
Now, what's really interesting here is the engulfing pattern. It perfectly visualizes a total shift in power. A bullish engulfing pattern happens when a small red candle is immediately followed by a massive green candle that completely swallows or engulfs that previous body. It is immediate, undeniable proof that control has violently shifted from the sellers right to the buyers.
Beyond the engulfing candles, we also have single candle pivots, like the hammer and the shooting star. The actionable trading strategy here is 3 simple steps. First, identify exhaustion via long wicks. A hammer has a long lower wick showing sellers failed, while a shooting star has a long upper wick showing buyers failed. Second, confirm the direction of the pivot on the very next candle. And third, execute your trade based on that confirmed momentum shift.
Now, let's see how this builds into multi-candle pivots. Because, sometimes the market doesn't just turn on a dime. Patterns like the morning star, evening star, piercing pattern, and dark cloud cover take 2 or 3 candles to fully develop. These are slightly slower, a bit more methodical momentum shifts, but they are incredibly powerful because they confirm a much broader, more established market reversal.
Section 3. Riding the market trend.
So while reversal patterns are about a big shift in power, continuation patterns are all about trend reinforcement. We're looking for specific patterns that tell us a resting phase is happening within an ongoing trend. Whether it's the rising 3 methods in a bullish run or a bear flag in a market crash, these formations tell the seasoned analysts that the dominant players haven't left the building. They're just reloading.
The flag pattern brilliantly illustrates this concept of a strategic retreat. After a strong, impulsive move up, that's the flagpole, the market will often consolidate, drifting slightly downward in a tight channel. It's literally just catching its breath. Amateurs see this drift and they panic, thinking it's a reversal. But as analysts, we know for sure it's a consolidation phase preparing to unleash the next leg of momentum in the dominant direction.
So how exactly do we trade this resting phase? Well, look at the highly reliable rising and falling 3 methods. The rule-based strategy is simple. Step 1, spot a strong, massive initial momentum candle. Step 2, wait patiently for a 3-candle shallow counter-trend pause.
Importantly, they shouldn't break the high or low of that first big candle. Step 3, enter the market the exact moment a new strong candle resumes that original trend.
And hey, sometimes the market doesn't even want to rest at all. Pure momentum candles, those massive bodies with almost zero wicks, they push the dominant trend so aggressively. And when you see runaway gaps, where the price just leaps forward into empty space on the chart, it signals an unstoppable force. These continuation signals are the market loudly confirming that the dominant players are absolutely still in charge and the trend is fiercely active.
All right, Section 4, Reversals versus Continuations.
So the absolutely crucial point here is understanding the fundamental psychology separating a reversal from a continuation. Reversals are born from exhaustion. We look for those long wick rejections indicating that the dominant force has literally hit a brick wall, leading to a pivot and a complete power shift. Continuations, on the other hand, well, they're born from consolidation. It's a temporary pause in momentum, a resting phase where the dominant force is simply gathering strength for the next massive push.
Which perfectly brings us back to the core philosophy derived from our source masterclass, stop memorizing candlestick patterns, do this instead. Doing this means analyzing context. A hammer candle only really matters if it happens at the end of a downtrend, signaling a reversal. If you see that exact same shape in the middle of a sideways market, it means nothing. Understanding the why of market momentum will always beat the rote memorization of patterns.
I want to leave you with a final thought to really challenge your trading edge. When you sit down, open your software, and look at the chart tomorrow morning, will you see random shapes, or will you actually read the language of momentum? You now have the analyst framework to distinguish a resting market from a reversing market. The market is speaking to you every single second of the day. Now, it's time for you to listen.